Welcome to Stifel's Investment Strategy Brief, a monthly recap of the macroeconomic and market environment.
Well, greetings and welcome to the Investment Strategy Brief podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this episode, I want to provide a little bit of a midsummer update on things like the Middle East, AI, Fed policy, earnings, equity markets, market dynamics more generally. And, it's our tradition in the summer to record one session for July and August. So it's towards the end of July. And we're going to do that here. And let's jump into it. Let's start with the Middle East. On again, off again is, I think, the way to think about it. We've had, at first, an agreement to work over 60 days to a peace plan. That fell apart. Attacks resumed back and forth. And then over the most recent weekend, as I record this, the U.S. sort of stood down and has talked about re-engaging in negotiations. This is all part of the geopolitical environment that we monitor. And so in this case, military conflicts that we're mindful of, this one being around U.S. in the Middle East. And recall that back in March, we published a piece around scenarios. We thought maybe a 10% chance of a regime change, probably not going to happen. A 15% probability of a severe tail, meaning it goes on a very long time. We don't think that's going to happen. Shadow war is that the exchanges keep going, even though at least the U.S. declares victory. We don't think that's likely to happen. We're still in the camp, and we had assigned a 25% probability to that. We're still in the camp of a managed off-ramp, although we think it's going to get a little bit more bumpy. So we had originally assigned a 50% chance to that. We still think that's where we're headed. And one thing that's becoming ever more clear is that this on again, then off again sort of pattern in part is diplomacy tactics on the part of the Trump administration. So what we've decided to coin or call, maybe others have talked about it this way, coercive diplomacy. So putting pressure on, obviously through attacks and the risk of more attacks, hopefully to ultimately improve the stance of negotiating, but really with the idea of getting back to the table, start negotiating again. And, earlier in this event, we talked about munitions markets and midterms, that we could run low on munitions. Markets may react. Thankfully, they've sort of recovered and are resilient. We'll get to that in a moment. And then we have the midterms coming up. So the administration is going to be mindful of how this might all affect things. Oil's been volatile. When the tax resumed, oil prices jumped back up. Since they've paused, they've come back down a little bit. Ultimately, what I would say about the environment is oil's moved around. But ultimately, while on one hand we're seeing interest rates a little bit higher, the equity market, just generally speaking, has been reasonably resilient. And so just think of it as markets generally have recovered. They've been volatile recently, but probably for reasons beyond the Middle East. And so anyway, again, I would just say holding out okay, but with the expectation that while it will take time, we'll get to a point of negotiating a peace agreement. Now, as it relates to the economy, continued close to trend growth. So think on average 2.1% since the beginning of this century, and we sit kind of right on top of that rate, pretty close. We know that the consumer makes up a big part of the economy. Looking at things like personal consumption, retail sales, the consumer remains very engaged despite having a slightly muted confidence and sentiment. And while we keep looking for cracks in the credit market, in the case of the consumer, we haven't really seen any. That's partly because of a still pretty close to full employment labor market. So unemployment sitting at 4.2%, jobless claims down a little bit. Now we'll say job openings as measured by JOLTS in a reasonable spot, sort of above the level of the pre-pandemic averages, but non-farm payrolls, so think job creation, a little bit muted. Most recent reading I have here as we record this, 57,000. And so just think of it as a low hire, low fire type of environment, but pretty full employment. We've also seen, thankfully, a little bit of softening inflation. Inflation coming down a bit and still not down to the Fed's 2% target by a lot of measures, but interestingly, the 1-year break-even rate has actually fallen below 2%. So there's this growing expectation that inflation is going to calm. And that sets up for most likely the Fed to hold where they are. There's a meeting as I record this that's concluding. It's happening as I record this, but it concludes tomorrow, July 29th. We're expecting at that meeting for the Fed to hold its rate steady. We'll see if that unfolds. And still with probably a decent amount of voices that will speak to the possibility, either through the meeting communication or afterwards, the possibility of hikes. But again, we think at this particular meeting, they will likely hold. And futures are signaling that, but that we should expect a couple of rate hikes based on futures as they're pricing in the relatively near future. So again, that's something we're going to keep an eye on. We know global central banks like Bank of Japan and the ECB have hiked rates 1/4 point recently. Now, as it relates to the economic growth overall, the consensus forecast for the full year 2026 sits at 2.2%, so just a smidge above that trend growth line. And 2027, the forecast sits right on top of that trend growth line of 2.1%. So we're expecting, again, the economy to hold up. Now, as this all adds up to an interest rate environment where interest rates are just a little bit higher. So again, think of it as sort of what had been a buildup of inflation, but also I think essentially the continued deficit spending and fiscal trajectory. These are forces that are probably keeping a little bit of upward pressure on rates, higher for longer environment, which we've talked about before. For bond investors, when it comes to forward-looking investments, that means yields have jumped back up a little bit. They're attractive. Again, in part because of that fiscal trajectory, but those slightly higher rates has meant that recently, and let's say year to date, some markets are slightly negative. So think of it as the negative price move from the slight increase in rates has offset the coupon income from the investments. And so, for example, the Bloomberg Aggregate Index is just slightly negative year to date. Now, turning to equities, we see profit margins, and earnings growth remaining resilient. We see the market sitting around just under a 20% premium on a PE ratio basis to the 10-year average. So market's still a little bit richly valued. And one of the things we sort of dug into this time was basically a view of sort of the concentration in the markets. Remember that a lot of big tech-oriented companies make up the top 10 companies in the market. And one thing that's been going on there, of course, is the AI CapEx spending. So looking at, for example, an important measure, what's called free cash flow. So, it's sort of like the money available for things like dividends and reinvestment after earnings are all calculated and all that. And bottom line is for the big hyperscalers, Google, Meta, Microsoft, Amazon, we uncovered a study where basically their free cash flow has been pretty healthy. It's going to decline as they make these CapEx investments. And then the forecast is over the subsequent years of 28, 29, and especially 2030, an acceleration in free cash flow, really capturing what is expected to be the return on that investment. Now, in terms of performance dynamics, this year to date, looking at the top 50 companies by performing in the S&P 500 performance year to date, 30 of the 50 are tech companies. And then one final sort of interesting point that I would make is we've done a little bit of analysis on quality in the small cap space. And what's been super interesting is when we look at the way we've measured it, which is to take the Bloomberg 2000, think of that as a diversified small cap index. We break it into two buckets, those that also sit in the S&P 600, which is a higher quality benchmark. Think of it as members that, roughly the expectation is that for the prior 4 quarters, I think there's positive earnings. So it's an index with higher quality companies. That group of higher quality companies in the Bloomberg 2000 if you go back a few years, greatly outperformed, and then in more recent years have greatly underperformed. Now, a lot of asset managers invest in quality, and so we've seen a lot of asset managers underperform, really anchored on this specific issue. So that's something we have been wanting to unpack. We finally got some custom indices built, and we were able to understand that. And again, we're at a point, it's a 2 standard deviation move from long-term averages. So we, by the patterns of history, would expect that at some point here to reverse. Now, as I recorded here today, so kind of middle of the day on July 28th, if I look at data through yesterday, just to pick one snapshot, we're seeing the equal-weighted S&P 500 outperform the cap-weighted. That's a little bit related to the Mag 7 year-to-date being down a little bit. So we've talked about in our outlook for this year, for example, a broadening market. And while things have moved around a little bit, basically that's what we've seen incrementally, is a slight rotation, if you will, in the leaders of the equity market. And by the way, small cap companies have performed well also year-to-date in this environment. Now, one final thing to talk about when it comes to the equity market is the recovery we've seen since the start of this Iran conflict. Over the 3 months of the period we're looking at, since it started, the subsequent 3 months, the market was up, and this is the S&P 500, 9.3%. And then since the start to roughly the 27th of February, as I record this, up 7.8. So just healthy recovery in line with what we've seen in other historical geopolitical shocks. Now, we keep an eye on things like the AI development, the investment of AI. We're seeing that, just continuing to pick up across the economy, basically different kinds of companies using AI. We know that there's an increased focus on how those investments translate to earnings, so that'll be in keen focus. And we've seen different kinds of dislocations, certain kind of stocks trading down and then recovering as people wonder about whether AI disrupts certain industries or companies, and then whether there's the effective implementation of AI within companies in certain industries. So all of that in keen focus, but still a lot of results to see and efforts to unfold before we can really unpack that in a significant manner. I'll just remind folks that we continue to focus on our long-term themes. How's the world changing, and how does that influence our investing? And I will sort of end by, just as I always do, inviting everyone to check out stifelinsights.com. And hopefully, you'll check that out. You'll find things like this podcast, a corresponding video, slide deck, and other things as well. So anyway, that's what we wanted to cover in this sort of fast-paced mid-summer update. I appreciate you taking the time to listen, and we'll catch you soon. Thank you.
Thanks for listening to Stifel's Investment Strategy Brief. Be sure to subscribe wherever you're listening to automatically receive each month's podcast in your feed.